Hello and welcome everyone. Today's payroll query is, what is incentive stock options? So let's explore and learn about ISOs today. The two common forms of stock options offered are incentive stock options ISOs, which are also known as qualified incentive stock options, and the other one is non-qualified stock options. A qualified incentive stock option is granted by an employer as a way to attract and retain employees. It gives an employee an opportunity to buy the employer corporation's stock in the future at a fixed predetermined price, which is also called the exercise price or strike price or grant price, regardless of the market value. The advantage of an ISO is that the employee do not have to report income when he receives the stock option or when he exercises the option. The ISO qualify for a special tax treatment and are not subject to Social Security and Medicare taxes when held for the required period of time after exercising. An employee reports the taxable income only when he sells the stock. Before getting into the details, there are some terms that will be helpful to understand. Let's go over them. Grant date. The date stock option incentives are granted or offered by an employer to the employee. When the ISOs are granted to the employee, he or she does not actually own the stock. He just owns the right to purchase the company stock in the future. Exercise, strike, or grant price. The price per share at which the employee will be allowed to exercise an option, means to buy the shares at some future date, which will be the exercise date. So this is the price at which the employer granted or offered the stock option. The grant price can be lower than the market value, which means you can gain a good profit if you decide to buy these options. Vesting schedule. To encourage the employees to stay with the company for several years, companies usually set vesting periods. Vesting period is a length of time that an employee needs to wait until they can actually buy the shares. There are two types of vesting periods, graded period and cliff vesting period. Under the graded schedule, the percentage of the options vest each year for a certain number of years. For example, 25% each year for 4 years. And the cliff schedule is that under which 100% of the options vest after a certain number of years. For example, 100% of the options will vest after 4 years. Note, the vesting is not only time-based, it can also be performance-based. Exercise date. As the options vest, the employee is able to exercise them by purchasing a certain number of shares at a stated exercise price. On the exercise date, the employee buys the company stock for the price fixed at the grant date. Now, what if the employer does not have cash in hand to exercise the stock option? Most often, the employees find it easy to do what is called cashless exercise, where the shares are sold immediately to cover the exercise cost, and the employee simply gets the net shares, which is the total shares vested minus the shares that were sold to cover the exercise price. Holding period. The amount of time the employee owns the shares after the purchase and before selling. For how long do you hold the shares after exercising an option will decide whether you get the preferential tax treatment or not. If after exercise, ISO shares are held for at least 2 years from the grant date and 1 year from the exercise date, then the taxes upon selling the shares will be withheld at preferential capital gains tax rate on the appreciation of the stock price, which is the fair market value on the sale date minus cost basis of the shares. Note that the capital gain tax rate could be much lower than your original income tax bracket. Expiration date. Be aware that stock options might have expiration date. It's the date the employee's right to buy a company's share ceases. Let's find out what makes an ISO so special. If certain conditions are met, then the income or gains from an ISO transaction will receive favorable tax treatment. Holders of ISO generally don't pay taxes when they exercise their options. Instead, they pay capital gains tax on the difference between the exercise price and the price at which they eventually sell their stock. Employees receive a tax benefit upon exercise of an ISO because the individual does not have to pay ordinary income tax on the difference between the strike price and the fair market value of the issued shares. No income is realized at the time the option is exercised. Instead, if the shares are held for 1 year from the date of exercise and 2 years from the date of grant, then the employee pays taxes at a long-term capital gains tax rate, which is usually lower than the ordinary income tax rate. The income realized by the employee at the time of the sale is taxed at lower capital gains rate and is generally not subject to federal income tax withholding or FICA and FUTA taxes. If an employee buys a stock under an incentive stock option plan and sells it before the holding period ends, then the ordinary income that is realized is not subject to federal income tax withholding or Social Security, Medicare or FUTA taxes, although the income must be reported on employees' Form W-2. Let's understand this with an example. 3 dates are very important: the grant date, exercise date, and the date of sale. Let's say on grant date January 1, 2021, your employer granted you 1,000 stock options at a defined exercise price or strike price or grant price of $2 per share, meaning you will be able to buy 1,000 shares at $2 in future, disregarding the fair market value of the stock on the future exercise date. Now let's say that there is a vesting period of 6 months from grant date, after which you will be eligible to exercise the option. The vesting period ends on June 30, and subsequently on July 10th, the stock price rises to $8. If you exercise the 1,000 options at that time, you will pay $2,000 to obtain the shares that are worth of $8,000 on the open market. On July 10th, you decide to exercise the option and you bought 1,000 shares at $2 per share on July 10th. Now, do you have to pay taxes on this bargain element? In case of the ISO, no. No taxes are due until the shares are sold. And the type of tax you may pay on the bargain element depends on what you do next. How much tax will be due depend upon when the shares are disposed or sold. If you wait to sell your shares until after the 2 year from grant date, the profit you will make from selling will be taxed at a lower long-term capital gain rate. This is called a qualified disposition. Let's say that you waited for 2 years from the grant date and your ordinary income tax bracket is 37%, But you will be taxed on the profit from the stock options at the long-term capital gain rate, which is ranging from 0% to 23.8% for sales in 2021. So you will get the preferential tax treatment on the gain from the ISO. Now, what if you did not finish the holding period requirement and sold the stocks in the same year as granted? Then it will become a disqualified disposition and you will have to pay the higher ordinary income tax rate on the profit from the sale. There are some differences between incentive stock options and non-qualified stock options that are important to note. The ISOs must be granted to the employees before they are accepted. NSOs or non-qualified stock options are available to people in the company aside from direct employees such as vendors and partners. ISOs and NSOs function similarly, though the main difference is in regard to the tax treatment. For the NSOs, you are required to pay the difference between the grant price and the exercise price at a standard income tax rate. I hope this video was helpful. Please let me know in the comments section what other payroll topics you will be interested in exploring with me. That's all for today. Bye.